care a lot about is making sure that all of y'all just get to meet each other. So again, use this chat, drop where you live, drop what you do, and connect with each other. Again, Instagram, phone numbers, emails, whatever. This is your chance. There are 100 people in here right now. So, couple little announcements, and then I'm like the intro to our guest today. So, first of all, we're going to be going to a lot of cities this year for hosting gigs events. We're going to be having a lot of small events and also big events. So, we'll be coming to Chicago, New York, Orlando, Austin, Dallas, Vegas, LA, a few others. And so all of that will be coming out soon. And so I'm really, really excited just for all of us to get to meet all of you people all over. Okay, one tip, because we need to record a video and post this, but if you are applying to jobs on gigs, I've posted jobs on gigs, and I swear the people that I always end up looking at longer are the ones who leave a link and comments. So if you're already doing that, great, but I cannot recommend that enough. It's basically like giving your personality a little bit of like, yes, you see my resume, my gigs profile, but leave some comments of why you actually want that job, why you think you'd be the right fit. And then also a link to your resume, to your website, to a portfolio. It always, always helps. So I can't recommend that enough. And then also platinum, you just upgraded platinum, which basically boosts you to the top of the employers list and automatically gives them your phone number and email. So they don't have to do that extra step of reaching out. So two just things I would recommend. We are launching our Discord channel, which is our platinum members are in there right now, but we're going to drop the link in here that y'all, for attending this, will get in before all the other gigs members. We're announcing it next week. So it's basically a Discord channel for everyone just to connect and like actually communicate with people in your city, in your job category, all that good stuff. And lastly, we have a podcast. Follow us, the Gigs Podcast. Give us a 5-star, all the good things, and spread the word. Get all your friends on gigs. Appreciate it. Okay, let's get into this thing. We're really, really lucky to have Tate Henshaw and Jason Moll. So they are leaders at ARC Business Management. They guide entertainers, athletes, and media professionals through financial and business decisions. Tate is based in Atlanta. He's the co-founder. He's an entrepreneur focused on generational impact through financial literacy. He's got 15 years of experience supporting Grammy winners, record labels, athletes, tech companies, and he was named top 40 accountant in America by CPA Practice Advisor. And Jason is a Nashville-based CPA, leads ARC's Nashville office and national tax practice. He's got a background in LA entertainment with Los Angeles entertainment law firms. He has served artists, actors, producers, athletes, and has become a trusted advisor in entertainment and business communities nationwide. So here's how it's going to work. If you've been in one of these, awesome. If you're new here, they're going to give a great presentation on all the things you need to know about tax and about just this whole world, freelancer, for about 15-20 minutes, and then there's going to be a Q&A. So same deal, just go ahead and raise your hand, post your questions in the chat, because Ginny here on our team is going to be taking notes on who's leaving questions so that we can call on you later. And also you can raise your hand, and what we'll do is we'll spotlight you, we'll spotlight our guests, Tate and Jason, and you can ask them and just go back and forth, and then we'll get the next one in. So we're going for an hour, but again, if we go long, we go long. So I'm going to get out of here, but thank you so much. Take it away, Tate and Jason. Come on in here.
Thank you, Nikki. I really appreciate that. I did want to just highlight one message I saw in the chat, which was from Stephen Ryan. I think he's got the best URL in the business, asiansteve.com. So got, the resume and everything rocking on there. Very memorable. So kudos for that. So we're going to get into it. I'm going to go ahead and do the thing where we share and we make sure it works and all that fun stuff. All right.
Looks great.
Working. Then I'm going to move my people back so I can see you beautiful people again, which will be great. And then we can get it rolling. Boom. All right. So high-level overview. Our goal is we don't have a whole lot of slides. We just want to bring up some main points, raise some issues that a lot of you guys are facing, And really what we want to do is then leave an adequate amount of time for questions for you guys, specific scenarios that you're dealing with, so that we can hopefully help out. If we don't know the answer off the top of our head, we'll take it down. We'll do our best to figure it out. And I'm sure between Nikki and the gigs team, like we can get back in touch with you, all that kind of good stuff. So, to Nikki's point with that great intro that she made, my name's Tate Henshaw. I'm the co-founder of a business management firm. We are based in Atlanta and Nashville. Got now 18 years plus of experience working in the entertainment industry for all things financial, from investments, retirement, taxes, bookkeeping, tour accounting, all that kind of fun stuff. And I know some of you guys are wondering if I started when I was 8, but actually I'm a little bit older than that. So I've got a fair amount of experience. I know a lot about taxes. I've dealt with a lot of taxes, but the reality is, spoiler alert, I don't actually file the taxes at ARC. So I actually brought the expert with me. So Jason Moll, Jason, why don't you give us a brief intro about yourself?
Sure. Not too much to add there, but like Tate said, I run up the tax side of things at ARC. I've been in the entertainment space not quite as long as Tate, maybe about 12 years now, and just decided to kind of focus on the tax side of things. I'm also based in Nashville, so kind of head up the Nashville office and Nashville operations for ARC as well.
Cool. All right. So we're going to jump right into it. I'm going to start off with the most earth-shattering, mind-blowing statement of all, which is how we should all start, which is keep good records, right? So I know all y'all are like, oh my gosh, these guys are blowing my minds. This is crazy. But in all seriousness, with, going on 2 decades of experience, this is the thing that will put you behind. This is the thing that will set you up for success. It's kind of your choice. Keeping up with how much money you made, we're going to get into it, but how much of it was W-2? How much of it was 1099? Do you have different states? All those kind of things. That's really all the things that we are going to need if you have a professional advising you to know. And what we hear a lot is my CPA, my practitioner I'm working with is not proactive. They don't give me advice. They don't give me anything that's really usable. And unfortunately, sometimes that is correct, and that is what happens. However, the pushback I would give is a lot of time gets spent just tracking down all the stuff. And so the more organized you are and the more put together everything is, the more proactive that the people you're working with can be, or that you can be yourself. So if you know how you're tracking on income and all that kind of stuff, it really sets you up to execute all the things that we're talking about moving forward. We'll talk a little bit about entities later, but when we're talking about separate accounts, what we're really talking about is separating your business activity into a different account. If you have an LLC, great. If you don't, we'll talk about it, but still just set up a different personal account to run the business activity through so that you can, just keep that separate. And so then once you get it separate, that allows you to track everything. And then as we're going to talk about later, it unlocks the ability for you to save as well, and calculate that really easily. So keeping it moving. A lot of this is probably rudimentary for a lot of you guys, but it's still good to remind yourself and still good to understand. So for the most part, you guys are dealing with 2 different kinds of income, right? You have W-2 income and you have 1099 income. If you're being paid through your LLC or something, it's likely 1099 income. If it's W-2, it's almost always going to be to you personally. So the difference there is as you know, when you're paid via W-2 as an employee, they are going to withhold taxes from your pay. And so if you're getting taxes withheld, assuming that you filled out a W-4 accurately, which, by the way, with the kind of jobs you guys are doing where you have multiple different gigs, can be extremely difficult to manage. So that's also something that you need to stay on top of, because usually when an employer is paying that out, they're calculating it as if only they are paying you, right? So they're saying, oh, this guy's going to make 25 grand. Well, 25 grand's in a pretty low tax bracket, right? But if you have 6 25 grand W-2s, they're all withholding at that low tax bracket. You can end up sort of upside down on that, if that makes sense. And we can expand on that again if you guys have specific scenarios. Then the other type of income is going to be 1099 income, which is where you are a contractor as far as status goes. And for tax purposes, what that means is taxes are not withheld from that. And so, you know, I've seen it hundreds of times, it feels like, but people get the 1099, they get the money, they don't realize that there's no taxes withheld. They go to file taxes, they realize they owe a lot of money because they've not adequately planned for that. And so really understanding how those work. And then, Jason, can you speak a little bit about how they should organize these different incomes as they come in?
Yeah, just generally speaking, you know, kind of like we were talking about on the first slide, making sure that you've got separate buckets. You know, and when I say buckets, I'm really kind of referring to bank accounts, and making sure that if you're getting paid through a paycheck where they're withholding taxes, putting that into your personal account, and then making sure you have that dedicated bank account set up for any 1099 income. And you know, it's important to note that 1099 income is it's kind of the word we use for it, but that doesn't necessarily mean that that income has to be reported on a 1099. It's really any income that you receive that doesn't have taxes withheld, essentially. And you know, when Tate was talking about on the other slide about, you know, business income, if you've got that 1099 income, or if you have any sort of income that's not having taxes taken out from an employer, that's considered business income. And you need to treat yourself like a business by having that separate account.
Yeah. And I'm already seeing a few comments about S Corps, and that's, Jason, exactly what you're talking about, right? It's like, if you're a status, it's an entity of a S Corp, or unlikely, but possibly a C Corp, you're probably not going to get 1099s because they're not required to send you a 1099, but you're still going to need to report that income. And it's still basically business income, contractor income, if taxes are not being withheld. So you'd still want to keep it in that same bucket. And, you know, increasingly, companies are more and more stringent on being able to pay through what we call like a loan out company or your own entity. So a lot of times you may end up with a mix, you know, especially if you end up working on some projects for, like, you know, award shows or different things for a lot of these big corporations. They're almost impossible sometimes to be able to be paid out through a corporation or a loan out company, an LLC, etc. Okay, so let's keep moving forward. So we're talking about tax categories. Now for you guys, I have sales tax there. It's probably not as big of an issue for you guys, for most of you guys, but it could be for some of the people that you are working for, or if you are involved in merchandise sales, then you know all about sales tax, I'm sure. So that can be really interesting to manage with a company that is selling in multiple different states. A lot of times with touring, concerts, etc. You know, I'm cognizant of, we've got people on here who, we're calling it music, we're calling it concerts, but we may have Cirque du Soleil shows. We may have theater performances, etc. But anything where you're moving around, managing sales tax, a lot of times you end up with the venue taking on that burden, which saves your client from having to register in every state that they play in. So, but again, probably not as impactful for you guys individually. However, income tax, a lot of people are familiar with income tax, right? We hear about it all the time. We think about it. Maybe you're even familiar with the income tax rates, et cetera. But self-employment tax, on the other hand, I find that a lot of people don't really understand and don't really grasp. So, Jason, can you explain to us, like, what is self-employment tax and how does that correspond? If someone has a W-2, are they paying self-employment tax or not?
Good question. So self-employment tax has a number of different names. It's called self-employment tax. It's called payroll tax. I call it the killer of the middle class, but that's a conversation for another day. But essentially, all earned income or non-passive income is subject to self-employment tax in addition to income tax. And essentially, self-employment tax is Social Security and Medicare. There's two portions. There's an employer portion and an employee portion. So generally combined, Medicare and Social Security is 7.65% on both halves. I think it's 6.2% for Social Security, and the delta is Medicare. What's that, 2.45?
1.45.
1.45, yeah. Combine the two, and you get a 15.3% effective self-employment tax rate or payroll tax rate. When you're taxed as a W-2, you automatically have the employee half of Social Security and Medicare withheld from your paycheck. So before you even get paid, your employer is going to take the 7.65% in addition to federal income tax. The other half of self-employment or of the Social Security and Medicare tax is paid by the employer, and it's called a payroll tax. When you're 1099 or when you're self-employed, you're both the employee and the employer. So you're on the hook for both halves of Social Security and Medicare, which is 15.3%. So a lot of times, when we file tax returns for individuals who are self-employed, they get this huge sticker shock because they think, well, I only made 50 grand. I should only owe $5,000 because I'm only in the 10% income tax bracket. But they forget about the Social Security tax and the Medicare tax that's on top of income tax. I could talk about this for hours and hours, but I think that kind of, touches the surface of what that is.
Yeah. And keep that in mind. We're going to talk about S-Corp conversions in a little while, which I'm sure a lot of you guys have heard about. That's really what S-Corp conversion is trying to help minimize. It doesn't really affect, income tax or anything else, but we're going to talk about demystifying that. It could help with the self-employment tax. So, when we talk about 1099 income, we're always counseling people to save a certain percentage, and everybody says, well, what is that percentage? And obviously, as me and Jason are trained professionals, the answer is always, it depends. And so, what we have seen over time is 25 to 30% usually is helpful. Now, if you're making, $1 million a year and you live in California, probably, could be a little different than that. But this is really generally going to put you in a good place. And so I want to talk about this a couple ways, because I know there's a lot of debate too about which one's preferable. Like if you, in theory, have a choice, you're going on a tour, that you could do W-2 or 1099. When you're evaluating those rates, you need to incorporate this percentage when you're comparing. Like if you're getting a 1099, you need to add that tax on the top. Like if they're saying $1,000 a week, you need to think that's $700 a week in my pocket, not $1,000 a week. And the more you are used to just making that automatic, like we've got here, like save immediately, put it in a separate account, automate it, the more you're able to do that, the more you're going to be set up for success. And I've yet to have a client get upset because they had more saved than was needed to pay in. I shouldn't say that. There's always clients that are upset about anything, probably, but generally, many more people are upset when they don't have enough saved, right? And they get that sticker shock, like Jason was saying. And probably if you think about that combination of income tax and self-employment tax, that's where you get to this number pretty quickly. It's not like you got to be making hundreds of thousands of dollars for you to need to be saving 25 to 30%. When you're starting with 15% with self-employment, it doesn't take a lot from an income tax perspective to get up to that 25 to 30% number. And, you know, just as context there, like if you're putting it in a different account, like get a money market, get something where you're at least earning some money. If you're more sophisticated on the investment side, you may be able to roll some kind of investments that are going to be liquid by the time you need to pay in. If you don't know what that means, then probably don't try that generally. But that's kind of a big one that can really set you up for success. Moving on, we get a lot of questions about entity setup and should I set up an entity? If so, what kind? And, you know, we'll talk on the next slide about, you know, are S Corps a magic wand that don't let me pay taxes? Well, Jason's going to talk about that in a minute. As far as the entities, there's really two concerns that you need to think about. There's tax, which is obviously the focus of this webinar and what me and Jason know the most about. But a big part of entities also is liability and liability separation. And I know somebody was mentioning earlier in the chat talking about insurance and all that kind of good stuff, which is great. And a lot of productions and corporations may require you to have workers' comp insurance to be paid through an entity as well, which is also helping protect them ultimately. But a big piece of, you know, our first two choices here as a sole proprietor or as a single member LLC, for tax purposes, there's really no difference. Okay. But from a liability perspective, there is a difference. As a sole proprietor, it basically means you're just using your social, they're paying you right to your personal account, all that kind of stuff. That's okay for tax purposes. Again, we still refer back to start a separate account for business income, put all that in there, put your business expenses in there, et cetera. But for liability, you know, you guys have been in, I'm sure, some crazy scenarios that some of us could only imagine. But when you are basically, well, it's funny now, I'm just realizing this, but a lot of times when we're talking about tours, I use the term traveling circus. But I know today we actually have somebody who works with a traveling circus, so I don't want to offend them because their traveling circus probably operates at a much higher efficiency than a lot of the tours I've worked with. But there's liability abounding there. And yes, you have the big umbrella, you have the big Goliath, but when you're still involved there, it definitely doesn't hurt to have an extra layer of liability protection. So really think about that, starting an LLC as soon as it's feasible. If you have any significant amount of business income, I would recommend propping up a single member LLC, starting a bank account in that name, doing your contracts through that entity as well, just to have that extra layer of protection. Then when we talk about S corporations, which by the way, there's other entity types, there's partnerships, there's C corporations. Those are unlikely to come into play with the type of work you guys are doing, just because partnership would mean there's two owners. and maybe some of you guys have some projects where there's more than one owner, but it's basically similar to a single member or a sole proprietorship, but there's just two people. So you don't necessarily, unless you have an LLC taxed as a partnership, you don't necessarily have liability protection through a partnership. The interesting thing that a lot of people don't understand is when you have an LLC, that really means nothing to the IRS. If you've ever filled out a W-9 for your LLC, you know there's a little extra box you have to fill out to say how you're taxed. So when you start an LLC, if you have a single member LLC, by default, you're going to be taxed as a sole proprietor. However, you could elect to be taxed as a different type of entity, such as an S corporation. That's probably going to be the most likely scenario for the type of work that you guys are doing. The reason for that is basically you're separating the income that that company is making into kind of a active and passive portion. Let me explain that. When you have an S corporation, you have to pay yourself as the owner a reasonable salary. Now, a reasonable salary, I don't think we have time to go down that rabbit hole too far, but just know if you're making $10 million and you're thinking a reasonable salary is 10 grand per year, that's not reasonable. We all know that's not reasonable. There's different levels of gray, and you can be, more aggressive, less aggressive, depending on how you look at it. But regardless, you have to pay yourself a salary. On that salary, you are paying self-employment tax. Now, you're getting half of it on your paycheck when you pay yourself as an individual, and then the company is paying the other half as payroll taxes, as Jason mentioned earlier. That payroll tax is a deduction for you as the business, but the personal portion is not. So let's say you made $1 million. Now let's say you made $200,000, because I don't want to get too crazy with it. You made $200,000. You paid yourself $100,000 salary. The whole point of the S corp conversion is you are paying self-employment tax on the salary portion, and you are not paying self-employment tax on the excess earnings. Okay, so that 15.3% you're not paying there. Now, we can get more technical because there's limits where some of these things run out and all this kind of stuff. But as a general rule, if you're thinking about an S conversion, you really need to talk to a professional to see if it actually makes sense. I'm not going to blow all of Jason's lines from later, because there's different things that you may or may not realize you're opting into, even though you know you're saving on the self-employment tax. Jason, did I cover all that okay? Anything to add there?
Nope, I think that's good. We're going to talk about it again in a couple slides, I believe.
Mm-hmm.
So we can get into more technicalities.
All right. So we really wanted to tackle, as finance and tax professionals, we see the same reels and TikToks and all that stuff that you guys see with these, tax strategists and let me help you not pay any taxes and all that kind of stuff. So, Jason, does starting a S corp or a trust or an LLC somehow enable you to not pay any taxes?
Definitely not. Yeah, I mean, to be honest, any sort of, TikTok, social media influencer tax advice that you get, generally speaking, you can probably find some, slivers of truth buried in those things, but they generally come with, a ton of caveats and disclaimers and conditions that most people don't meet. And the truth is, people talk about tax loopholes all the time. There's no such thing as a tax loophole. There just isn't. 90% of winning with tax is being prepared and keeping good records. It just is. There's, making sure that you're capturing every single expense that you can during the year and separating those into buckets, you're gonna get more benefit doing that and capturing those than trying to find some magic bullet to help your situation. Um, just to kind of drill down a little bit on the S corp situation, since that's kind of the biggest one here. Um, Generally speaking, we're not really pushing people that direction anymore after the Tax Cuts and Jobs Act of 2017. That introduced the 20% QBI deduction, which we can talk about a little bit more, but essentially the benefit with the S corporation, Tate kind of already talked about how you've got the salary portion that is going to be subject to the self-employment tax, but then the benefit is that you avoid the self-employment tax or payroll tax on the profit portion. The problem with that nowadays, after the new tax law, is there's a 20% pass-through entity deduction. That's basically a free 20% deduction on your net business income. So if we take two scenarios where we have an S corp and we have just a regular sole proprietorship LLC, if that LLC is taxed as a sole proprietorship and we've got $100,000 of profit, your QBI deduction is going to be $20,000. If you have an S corp and you've got $100,000 of income before salary, and you say you run a salary for 50%, well, that salary is going to be a deduction against your QBI. So now you've got $50,000 of net income and you only get a $10,000 QBI deduction. So that compounded with potential state franchise taxes, the slam dunk the S corps used to be, just really isn't the case anymore. So generally speaking, and then you've got the additional, costs of you've got to pay for a corporate tax return, which is generally twice as much as a personal return. In addition to your personal return, you've got to run payroll for yourself. Not only do you have to run payroll for yourself, you've got to have really good record keeping throughout the year so that you know what your salary is, so that you don't inadvertently pay out more profit than you need to. So the margin for error and the net benefit of an S corp has just kind of dwindled away.
Yeah. And you stole a little bit of our thunder on the next slide. So,
Oh, joy.
we'll work on that later. So in our recap, but I do want, before we move forward, like, just to be clear, there are use cases for all of these things, right? S corps, to Jason's point, the Venn diagram kind of is shrinking, but that doesn't mean there's not still a use case. Trust, great things for privacy, great things for estate planning, but not very rarely is anyone with a net worth south of $10 million going to use a trust to save on taxes, because that means usually you've got to give up control of money and do all these other things that don't make sense for 99% of the population. LLCs, I mentioned, great for liability protection, don't really do anything for tax in and of itself. So just keep that in mind. And yet, so Jason mentioned, like, make sure you're planning for states. I think this is actually really important for this group, because I know that a lot of you guys, if you're on a big tour and you're on a W-2, you got the probably surprise at some point of getting that W-2 in the mail, and it's like 20 or 30 pages long, perhaps, and you're getting taxed in all these different states where the tour is located at. And so that's a really high administrative burden for the crew. And, we deal with it from the artist perspective too. When you talk about, we're talking about state specifically here, but when you get into, international, that's a whole other level of complication, because you're dealing with international tax credits. And so, that's really difficult to manage yourself as an individual. and I'm not hard selling any kind of services, but just know we deal with that kind of stuff all the time because you need to evaluate, is it worth filing in all these states? What is my potential exposure? Did they withhold enough to where I'm probably okay? And I'm not giving any of this as official advice, just FYI. But international, same thing. Okay, we went to Canada. They had made me fill this thing out. They withheld 20-30% of my pay. What do I do with that? How do I even find someone in Canada who can file a local return if I need to? So, that's definitely an area you can get really bogged down and trying to figure out what do I need to do. But we are definitely, and it's not just us, there's other people, but we're very familiar with those kind of scenarios. And I know how much stress that can put on crew members and things of that nature. So, and then just kind of making sure I follow my slide here a little bit. Different states also have very different tax rates. So understand that. Understand that, there's a calculation. If you're based in Tennessee, that doesn't mean you're not going to pay state income tax. If you're on a tour, if you go over to California, you're going to pay California for the time that you're there, especially depending on how that tour reports that on a W-2. And Jason kind of touched on it, but like some of these states, you think, oh, I'm doing this S conversion and I ran the numbers and it looks great, I'm saving on self-employment tax, but then you may opt in unknowingly to a corporate tax rate in that state as well that could mitigate and or eliminate all of those savings that you thought you were getting. And then that last point is kind of what we just talked about. But, being on a tour definitely creates some complications for individuals when you're filing taxes, when you're dealing with so many different states and things of that nature. So we're definitely very aware of that. And it's a lot to manage for sure. We can get into more specific questions there when we get to that point. So I know a lot of you guys are like, this is basic stuff, but Jason, can you expand on our tax deadlines and how that relates to both filing and paying? And specific leading question, if I don't have all the money to pay my taxes, should I still file my return?
Yeah, good question. So generally speaking, the deadline to file and pay a personal income tax return is April 15th every year. And like Tate mentioned, April 15th is the deadline to file and to pay. You can file an extension to extend the filing deadline to October 15th, but it's important to note that that is only an extension of time to file. It's not an extension of time to pay. So if you get to April 15th, you've got your tax return prepared, you owe a bunch of money, you can't pay it, you kind of have two options. You can file your tax return and set up a payment plan at that point, or you could file an extension, not pay, and then whenever you get to between then and October 15th, when you get ready to file, hopefully that gives you some time to put some cash together. But if not, just know that interest on any amount that you owe will begin to accrue after April 15th. But keep in mind, even if you can't pay, absolutely you want to file the extension by April 15th, because if you don't, you're going to be hit with a late filing penalty in addition to the interest. So just remember, extension of time to file, not an extension of time to pay. And if you have the money at April 15th, but you're just not ready to file, you can file the extension with a payment. If you overpay, you can always get a refund when you do eventually file by the deadline.
Yeah, I think that's actually a great scenario, and it's something a lot of people think, oh, well, I'll just wait to pay it when I file it, or I don't have the money, I'm not going to file it. But it's not exact math, but the late filing penalty is about 10 times as severe as the late payment penalty. So
Yep.
just keep that in mind. Even if you can't pay, please, please, please still file the return, because that's going to just continue going, right? And it's going to really add up. And then they add penalties and interest and all that fun stuff. So not a great scenario. There was one comment in here too I wanted to comment on real quick. These are individual tax deadlines. So for businesses such as corporations, partnerships, it's actually a month before. So it's March 15th, September 15th. Most times, unless somebody has a C Corp for some reason, the payments are going to be tied to these deadlines that we're showing on the slide, because a single member LLC, such as a sole proprietor or an S Corp or a partnership, those are all pass-through entities. So the profit normally flows down to the individual and they pay the tax based off of that. There may be, to Jason's point, some state-based corp filings and stuff like that due at the other deadlines, but predominantly the payments are going to be tied to these dates. All right, so wrapping up the slides, at least, action items. Make sure you have a business account. Again, even if you don't have an LLC, just set up a different account to flow everything into. I know a lot of people are like, man, I'm freaking out about 2025 taxes. I wasn't organized, blah, 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 all this kind of stuff. You're going to get through it. It's going to be okay, but don't use that as an excuse not to do 2026 correctly, because otherwise we're going to be in that perpetual cycle of repeating everything, right? Don't repeat that pain. Like, let's do this year clean, and then you'll be in great shape, because that's going to allow you to automate those tax savings and track your income and expenses to know where you're at. And then number 4, if needed, if you've got a W-2 with 30 states on it and, international stuff, or you're just curious, what are my options? Definitely consult a professional, because we deal with these kinds of complicated situations all the time. And what we're here to do is ultimately take stress off of you so that you can get back to doing what you guys uniquely do well. So that's it for the presentation. So hopefully we've still got a little bit of time for some questions.
Yeah, of course. Tate, can you just, yeah, there you go. Perfect. I'm gonna, um, how this works is you just raise your hand, the little hand thing. Or if I found you in the chat with a question, I'll call on you. Then we'll just go one by one. I'll spotlight you with both Tate and Jason. You can ask your question and then we'll go on to the next person. So I'm gonna start with Bob Prenger. I think that's how you pronounce it. Has a question in the chat. So if you just want to unmute yourself. Going once.
About the Casper Crew question.
The one,
Yes.
yeah.
Yeah, I put a reaction on that the comment that Bob had about the casting crew, because I got a W-2 and it's like 10 pages, like 17 states.
Yeah. So Jason, if you're not seeing it, the question is, cast and crew separates out state pay per show. Do I need to adjust for off days or rehearsals in different states as well?
I don't know that I totally understand what he's specifically trying to ask, but generally speaking, we go by what the W-2 reports. So the W-2 does a good job of showing the earnings by state. So if you're saying, like, if you spent an off day in another state that didn't have income tax collected and reported on the W-2, we generally don't worry about all of that, or any of that, I should say. The one state where we do have to get some figures on is New York. For some reason, anytime you've have income sourced to New York, On the W-2, they put the full amount of your earnings on the New York section. So we have to go in and allocate the number of days that you are in the state to get that allocated. But otherwise, go by what's on your W-2.
Yeah, because if you report different amounts, like then you're getting notices and all that. And even if
Yeah.
it's slightly different or you think that the allocation isn't exactly correct, like it's not worth going through that process because then they're going to make the company try to amend the W-2 and all that stuff, which is just a cluster. I mean, unless it's like vastly incorrect, right?
Yeah.
Like, okay, they allocated half my income to California and I was there for 2 days. Okay, you're going to go back to your employer and ask for them to fix that, not like the state themselves.
Thank
Thank
you.
you so much. Yeah, thank y'all for those questions. Next, I'm going to go to Billy.
Okay, hi. Thank you for doing this. I had a quick question about, so a, I have a startup where it deals with touring and activations and like fan zones and stuff. And it goes on tour. The idea is that we go on tour with artists and help them collect data. My point being is, or my question was, um, do I have to register if I'm being paid by the label, by like Warner or somebody? Do I have to register Warner, who I guess would be based in Nashville or in LA, depending on like where their taxes come out or wherever they're at? Do I have to file as an LLC or not file? Do I have to register in all of the different states that I'm touring in, or am I okay just staying in um, as like registered in Tennessee?
Yeah.
You're saying for the entity itself being
Correct.
registered. So generally, I don't know if this is one we want to release on the socials per
That's the
se,
million
but
dollar question right here.
yeah. Generally, we wait until somebody makes us register in the state to register in it. So, that would be my general advice there. And different states are going to be more on top of it. You may have to balance, like, for example, uh, if we have artists, if they go to California, they can get paid there, but if they're not registered with the Secretary of State, they may withhold some taxes from them. So then if you want to get that back, you got to go file a return. You got to do a lot of different things. So there's a little bit of a balance when it comes to how much administrative burden do you want to take on and is it worth it? Like if you're getting paid $1,000 and they're withholding $50, is it worth registering there? I know what I would do, probably myself. But if you're getting paid $100,000 and they're withholding $5,000, maybe different story, right?
Yeah. I wouldn't go out and just, willy-nilly register your LLC in every state you go to. It's like Tate said, it's a balancing act. You've got to weigh the pros and cons of doing it. But generally speaking, if you're in a state and it's not making up a huge portion of your income, it's probably not worth the burden to do it. Now, if you're constantly in one specific state and it's making up half of your income, that's probably a state where you should raise your hand and apportion appropriately.
Okay, thank you so much.
Thanks for the question, Billy. All right, next I'm gonna go to Joshua Dirks.
Hi, fellas. Can you hear me?
Yes.
Great. My question was, at what point would you recommend someone stay a sole proprietorship versus turning into an LLC versus converting to an S corp? Obviously, the LLC gives you legal protections. So if you're doing enough work, like there's got to be a threshold at some point that you guys are like, oh, you've done enough work that you probably want to protect yourself legally. And then at a certain point, is there still a spot where it's worth it to convert that LLC into an S corp for tax savings?
You're going to need a lot more detailed info probably to make that determination. So for one, like the nature of your work, like the more risky by nature your occupation is, you know, you're going to want to go more legal separation earlier. Like, I don't
And
know.
your personal net worth as well.
Correct. Yeah, because you have to think you're balancing, like, I can't get the circus thing off my mind now, but like if you're a fire breather, right? Like there's some inherent risks there, needless to say, and you may be covered by the production itself, you all that, but like needless to say, we're in a very litigious society. So I would say like immediately. But what you're balancing, to Jason's point, is if they sue you, something happens and you're found liable, in theory, they could get to your money in the LLC, but not your personal money. If you have an LLC, if you're a sole proprietor, in theory, they could get to all of your personal assets as well. So if you own a home, if you own all these, automobiles, assets, investments, you don't want that exposed to any potential litigation and things of that nature.
Yeah, I would say too, the difference between, at least in Tennessee, the difference between a sole proprietorship and an LLC taxed as a sole proprietorship is about $500 a year. You're going to pay $310 for your annual report, $100 for a franchise tax, and potentially a business tax for your business license if you have one. So if you're not worried about $500 a year, there's no reason not to just go ahead and get the LLC. If that's really, you're going to have to work super hard and the $500, it puts a huge dent in your cash flow, then maybe you wait, depending on the other factors. So.
Yeah. And then I think the S conversion is really, you're going to need to do a custom calculation because it's going to depend on your state. And like Jason said, the QBI, all those kind of things.
Generally in Tennessee, an S corp is not going to be worth it for anybody for tax purposes. S corps are great when we're allocating income between different states, but that's more of a, mechanically it's easier to do that. It's not really a tax savings play. California, Georgia would be a little bit more friendly, but I wouldn't consider it until your take home pay is at least six figures, 100K.
Great.
Thanks, Josh.
I think that answers everything for me. I appreciate it.
Mm-hmm.
Awesome. We're gonna do two more. I'll do Maggie and then Dory. So Maggie, if you wanna unmute yourself. Then also you guys, I put the information for these guys in the chat. So definitely reach out too. And this will be posted on YouTube, full recording. So if you want to look back or you just didn't get to see the whole thing, got in late, whatever, we've had plenty of people reaching out during this saying they can't make it. So it will be posted, don't worry. But go ahead, Maggie, if you're still here, if you want to go ask your question.
Hi guys. I just wanted to go through high level what some common write-offs for most like self-employed people might be in this industry. Like I tour manage, but I also am an artist manager, so sometimes on tour, but a lot of the time I'm working at my home office and I'm working, what kind of basic things could be there. Like, is it as simple as computer and maybe my vehicle? Is it even like a portion of my rent? And the tour managed stuff, is it like, like my show blacks or, other gear that we have to invest in to do this work? It doesn't have to be exhaustive, but on the top of your head, like what categories qualify for that? This is my first year filing in the States. I'm a citizen from Canada. So getting accustomed to all of the changes for this year. Thanks.
Jason, you want to take that one? Or you want
Sure.
rock, paper, scissors?
Yeah.
Either way.
So that's honestly one of the hardest questions I get because I'm not walking with you throughout the year on a daily basis, right? So one thing that I will say is I am not a fan of spending $1 to save 30 cents, right? So we're not looking for things to spend our money on for tax deductions. So really, it becomes more about taking each and every day, each and every transaction one by one, right? So this is where having the separate accounts comes into play. So the IRS basically says you can deduct anything that's ordinary and necessary in carrying on your trade or business, right? So as you're going through life and you've got your two different cards for your business and your personal account, you're going to buy something, ask yourself, is this going to do I need this for my job? Right? Or is this going to make it easier for me to do my job or be more efficient in my job? And then ask yourself, would somebody else in my line of work also have to incur this expense? And if you can answer yes to both of those questions, it's probably going to be deductible. So use the business card. Now, the ones that you specifically mentioned are kind of mixed, kind of a mixed bag, right? You've got personal use and business use. You've got a car, you've got a home office. And with those, generally, we can take a piece of them. So you can look up the home office deduction. Happy to talk to you about that, afterwards about what that looks like. But essentially, you can take the business use portion of your rent, your utilities, things like that. And then for your vehicle, make sure you're tracking your mileage throughout the year, keeping a mileage log of, all the miles you're driving, business and personal. And we can either do, a standard mileage deduction or potentially take the business use of the depreciation and the actual expenses of your vehicle.
Sounds good. Thank you.
Yeah.
Thanks for your question, Maggie. All right, Dory, will be our last question.
Hi everyone. I'm Dory. I'm a production manager and often am on tour. I operate under a single member LLC, so I'm paid primarily through 1099s. And I'm just trying to figure out like the per diem that I receive is calculated as ordinary income. So I use GSA rates to calculate what the per diem was for each like stop of the tour that we were on. But I'm wondering, how do you properly calculate the per diem rate for the first and last date in a city when it's not like we're not going home afterwards? Because usually that rate is like a 2/3 or something. It's like substantially less than the day rate. So just wondering, like, how do you calculate that day when it's a travel day, but you're still in a different city away from home?
I see Jen's waiting on me to answer that one. It's probably not politically correct comment, but the fact that you're thinking at that level of detail is great, and the likelihood of someone coming in and challenging that you took half instead of 2/3 of the per diem on the last day of the tour seems pretty minimal to me. So I would be, a little more aggressive on it. And then there's also, sometimes you can do the kind of standard per diem rate depending on what cities you're going to. Like if you're not going to high cost of living cities, the standard kind of nationwide rate could actually be preferential.
Okay, but I guess like if I'm in Atlanta one day and then the next day I'm in Charlotte, for that day that it's a travel day, am I choosing Charlotte or Atlanta if the rates differ?
Well,
Or it doesn't matter?
as the math person here, I would probably say which one's more because you're deducting it, right?
Okay, thank you.
And I would just, if you're documenting that, just keep documentation and put Atlanta, boom, and then Charlotte the next day. And I don't see that being an issue.
Perfect, thank you.
All right. That's all we have time for, y'all. Again, like, thank you so much for coming. Really hope you guys connected with people in the chat in the beginning. Thank you guys so much for your time, Jason and Tate. Really, really grateful to get to do this with you guys. Excited to see all of the clips and stuff we're gonna get to share with everyone on social media. Y'all reach out to ARC Management, to Gigs, to Tate and Jason with any questions, anything. Hope you all learned something. I certainly did. Super beneficial. And good luck with tax season. If you were a little worried before, hopefully you're not as worried anymore. You guys had some great questions. So really excited about our next mentor masterclass too. Make sure to like DM us with anyone that you want to hear from or topics that you need covered. And we'd love to meet those needs for y'all. But Jason, Tate, anything else before we close?